On paper, global mining output has been growing, but it has not grown fast enough. Copper prices rose upwards of nearly $13,000 per ton on Jan 6. TCRC has fallen from nearly $100 to about $20 over the last 10 years. Many of these smelters have had to suspend operations because of the margin pressure that are involved. Copper isn't running out tomorrow, but we could be quite close to it. The world copper mine production stands at about 23 million tons, and the world refined production was about 28 million tons. And when you compare this to the amount that was used of copper, that was sitting at about, again, 27 to 28 million. So we are hovering very close in terms of what is being produced and what is being consumed. Now, when you look at the copper inventory that's there globally, that's sitting at about 1.4 million tons at the end of 2024. And by the end of 2025, nearly, we were sitting at about 1.5, 1.6 million tons. So these inventories, when you think about it, aren't necessarily long enough or large enough to be able to absorb any disruptions that happen. We're basically running as close as we can to capacity. And now the real crisis that's coming in terms of copper is that the demand for copper is rising much faster than what the industry can reliably produce. And ultimately what we're seeing is bottlenecks in the entire supply chain in terms of the mines, the concentrates, smelters, refined metals, etc. So that's why copper is increasingly being treated as now a strategic material, a material that is having geopolitical implications rather than just any other commodity. So this is the copper crisis in a nutshell. Today what we're going to do is we're really going to sort of break it down and help you understand the different components that are there from the demand side, the supply side, and overall from a geopolitical angle as well in terms of what is happening with copper and what we can expect in the next couple of 5, 10, 20, 30 years for copper as well. So let's start with electrification because it's copper heavy by design. EVs use 4 times as much copper as combustion cars. Before you even count chargers, substations, grid upgrades, all of the necessary things that you need EV to run properly. And that's essentially a multiplier effect there as well because when copper's demand rises, it's not just because of EVs rising, it's also that the entire ecosystem that supports EV running on a day-to-day basis needs to rise and needs to adopt as well. The second point here is that there is the electrical grid, the energy transition that's taking place from moving away from, let's say, coal plants to solar and wind. We are rewiring distribution networks across countries. We're adding more transformers. We're expanding transmissions. There is battery storage that's coming in. There's redundancies that are being built to ensure electrical support systems work properly. And all of these are very copper intensive assets with large and very long lifetimes in terms of decades and multiple years. So what all of that means is that this demand that's there is more a longer term demand as opposed to a short term blip, and it's essentially infrastructure capex that's happening here as opposed to just normal consumer spending. Finally, the third point, and this is something we've spoken about a lot historically as well, it's to do with data centers. We are seeing copper shortages also become a systemic risk if the supply doesn't scale, and global copper demand and data center related copper demand is expected to increase from about 1.1 million tons in 2025 to nearly 2.5 million tons in 2040. And when you look at the grand scheme of things, this isn't a marginal increase. This is something that is a significant amount of copper needs to be sort of added in from a supply perspective to contribute to this growing demand for data centers and AI enablers. So we've understood the demand side, the 3 criteria that are there. Let's look at the supply side. On paper, global mining output has been growing, but it has not grown fast enough. And even when you look at utilization numbers of a lot of these mines and plants, that'll tell you a much deeper story. We're sitting at about 80%, 81% mining capacity utilization. The world has added its smelting capacity much faster than it has been adding mining capacity, especially in Asia. Now this matters because when you mine, you don't just sort of sell refined copper immediately. Much of that sits as a concentrate that must be processed and refined, and you can see the supply chain in the image there. So if the concentrate supply is lagging, the smelting also grows but is sort of going to sort of lag, and you're going to see the pinch really hit the middle of the chain first. Now when the concentrate is scarce, any unexpected issues that happen in the supply chain in terms of the mines, any delays, any regional disruptions, those can be very large effects on the entire supply chain. They can cause pricing issues, they can cause margin impacts for many of these players because there is no slack, there's no cushion to be able to absorb a lot of that shock. So this is where the crisis becomes real, because you don't have the necessary bandwidth to solve for these unplanned disruptions. And here are a few. So for instance, there was a Grasberg incident where in Indonesia there was a massive supply shock that basically meant 25-26 expectations had to be revised. There was nearly a 400,000 ton deficit in the market in 2025, and this is potentially one of the largest that we've seen in the last 20 years, and a lot of that has been tied to other disruption that we've seen in Indonesia, Congo, Chile, and many other countries across the world. So when these shocks collide with structural demand, you get extreme pricing signals. Copper prices rose upwards of nearly $13,000 per ton on Jan 6th as the bull was sort of gaining momentum in this commodity. So to understand why the industry is again talking about a crisis, we've understood this demand, we've understood the supply, but are there any clear metrics? Well, one clear metric is known as the TCRC. It's known as the treatment and refining charges. In simple terms, miners sell concentrate to the smelters. Smelters are charging a fee known as the treatment and refining charges, or the TCRC, to turn it into refined copper. When the concentrate is abundant, when you have a lot of it compared to the smelting capacity, smelters have pricing power and the TC/RC is higher. But when the concentrate is scarce, as it is right now, smelters are competing for the limited supply of concentrated copper mined, and miners have sort of the upper hand, which means the TC/RC sort of collapses. And that's what we've seen. The TCRC has fallen from nearly $100 to about $20 over the last 10 years. This has shown how quickly the smelting capacity has grown and has sort of overtaken what is available from the concentrated supply side of things. But something interesting happened in the last 1 year. The situation has gone from a lows of $20 to an extreme where the prices that are being spent have nearly approached zero or gone below zero as well. So that means copper smelters are effectively paying the concentrates, the plants, to keep their plants running. And since smelters don't benefit from high copper prices the way miners do, because their economics are more dependent on the TC/RC and the byproducts that they get, many of these smelters have had to suspend operations because of the margin pressure that are involved. Now, new mines take years to build. There's permits that are involved. You have to find the relevant resources to be able to mine, and existing mines are also facing a decline in terms of ore quality. There's higher costs and even just overall supply. So what you're seeing is a double whammy here. New plants can't be built fast enough, old plants are becoming obsolete faster, and hence the supply is constrained, and your ore grades are also falling. So while you have this new smelting capacity being added, and that's coming on much faster, especially when industrial policy and financing are supportive, the concentrate isn't really increasing as fast. So the real driver here is the overcapacity in the smelting relative to what is available from the concentrate supply growth perspective. So where can this copper crisis realistically go? Well, in the near term, we expect prices to be volatile and even supply chains and flows to be volatile. China is exporting nearly 800,000 tons of refined copper in 2025, despite being the world's largest buyer, because they're seeing tariff threats, there's regional premiums that are being created due to arbitrage in terms of incentives and trade routes being shuffled, etc. It's essentially a market which is contorting to how metal needs to sort of move depending on the price that's available. So we expect a deficit in terms of refined copper output to be about 150,000 tons in 2026, and due to refined production being constrained and the concentrate availability being limited. And China, like we said earlier, is consuming a lot of this global refined copper, nearly 58% of it, which means China's concentrate availability, how the smelters are behaving there, the policy decisions that China takes are sort of setting the tone for everyone else as well. Without any major supply response, the deficits here could reach upwards of 10 million tons by 2040, which will be roughly 1/3 of the current demand that is needed to be met. And when you look at mined copper production, that may need to rise from about 23 million tons to upwards of 32 million tons by 2035, 2040. even when you account for any recycling growth that's there. So these are multi-decade projects and pipelines, and they also explain why copper has now sort of shifted from being just a commodity, which is typically cyclical, to something that's more geopolitical. So we hope you enjoyed today's video. Do like, share and subscribe. Let us know in the comments what other topics you want us to cover next. See you in the next video, and happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.